What if I told you there is a cover call ETF out there that actually is doing better than the index it's tracking just by price alone, not even factoring in the dividends? This is a reaction video to a fund that I just saw tonight. It's not new to me, but it is. I was just simply going through all the Canadian cover call ETFs here in Canada. I typically like to do that every so often, and I don't know why I never saw this before, but I see it now. I think this is going to be a really important video. Please stay tuned, because I think this is going to be a game changer for the whole cover call landscape, in a sense, I hope. So stay tuned till the end of the video. I'm going to do a comparison video just to show you guys the sort of, I think, basic math. I'll be speculating a little bit, but hopefully it makes sense of how it's actually doing better than by the index that it tracks. Now, I say it tracks, but I would say is the closest relative of what this fund is trying to achieve based on an index that holds a lot of the same companies, okay? So it's not a one-for-one, and this just being a cover call version of it. But anyways, let's just get into it. I'm not going to do a super in-depth dive into this fund. It's just going to be, I'm just going to sort of gloss over the basics. So this is HTA Harvest Tech Achievers Enhanced Income ETF. So it has a net asset value of 21 million. So it's on the lower end, I would say, even by Canadian standards, on the lower end. It's got a really amazing fat, juicy yield of 10%, which is great. This ETF holds, so it's an ETF that holds an ETF, which is actually another Harvest fund, which is the Harvest Tech Achievers Income Fund. Okay. The reason why it does this is because HTAE is a leverage fund. It employs modest leverage, meaning 25% of this fund is borrowed money that it applies to basically all the holdings of this. So as I've said in a prior video, what leverage is going to do for your investment is it's going to transform, say, if you invest $4,000, it's going to act like a $5,000 investment because of that 25% leverage. So you're obviously adding just that $1,000 to it. Maybe another note is that the risk rating here is high. If you look at HTA, its risk rating is actually medium. So I believe that the high rating is due to the leverage that is on the fund here. You can see it's eligible for RRSP, TFSA, RRSP, or your RIF. Okay, let's get into the holdings just to do a side-by-side comparison. So we're now just jumping over to HTA, because HTAE is the fund with the leverage component that holds this ETF, an ETF that holds an ETF. So HTA holds all of these different tech companies. Okay, and we're going to compare it to the holdings. Actually, let's make sure that we can see the top holdings here. So keep in mind, with Advanced Micro Devices, Intuit, Micron, Accenture, Adobe, Broadcom, Cisco, and if we compare that against the fund that I picked, which is probably it's basically the biggest tech ETF in Canada, I believe, which is HXQ. And I just went to the holdings section just to show you guys a comparison. Yeah, you can see NVIDIA's in there, but none of those other top holdings are in there. So like I said, I picked this ETF to do a comparison because I think it's simply just the closest. HTA holds 20 hand-picked companies, where HXQ is just matching the NASDAQ 100. So it's holding 100 companies with different weightings, and HTA is just holding, it looks like, an equal weight of 20 different tech companies. That, in a sense, because it's 20 just hand-picked, will certainly help with driving the yield upwards. But I also wanted to look at the prospectus so you kind of understand the structure of the fund from the cover call. And as always, we look at two things when looking at cover call ETFs, which is how much coverage is the cover call working on the fund itself. And right here we got 33%. Harvest will not write more than 33% of the fund. So 66% of HTA gets to participate in full market appreciation or depreciation, whatever the flavor of the day is with market sentiment. So 33%, no more. But that means, too, is it's not limited to 33% only depending on market conditions. It can write less. It could write 25%. It could write 10%. It's really up to the fund manager. So they have flexibility there as well. Number two is the moneyness. So when we talk about moneyness, we talk about out of the money, at the money, and in the money. And typically with cover call ETFs, we're not talking about in the money. We're talking about out of the money and at the money. Again, here it's flexible. So on the portion of the less than 33% coverage, they have the flexibility to write out of the money calls and, as we can see here, at the money calls. At the money calls. So flexibility with the coverage and flexibility with how much they are writing on those cover calls. Okay, so if you want to check that out for yourself, it'll be in the description below. As always, page 40 of the prospectus. Okay, so now that we've been through that, let's actually look at a side-to-side comparison of these two funds. HXQ, which tracks, like I said, the NASDAQ 100. And then we have HTAE, which is the Harvest cover call with the 25% leverage. It holds one ETF, which is HTA, with those 20 funds. So it's the ETF that holds an ETF. HTAE simply just has the leverage component. That's why it's a little bit different altogether. But as you can see, why I picked the NASDAQ 100, you can see for the most part, these funds actually kind of follow a fairly similar track. But here we have, just with total return, HTA year to date is up 34.44%. This is nuts for a cover call ETF. And compared against, say, a very popular index like the NASDAQ 100 is truly just mind-boggling. How is it able to do this? Okay, so that's just total return. Actually, let's take a quick look at just price return, just by itself. So you can see that these funds are, man, they are like, and even there, HTAE is still like 1% and a little bit ahead of the NASDAQ 100. Like I said, I think this is this something that I'm absolutely going to invest in? It's going on the watch list. Now, with the way the market is currently, with the debt ceiling issues, and we are waiting for the most anticipated recession in history at the moment, I think I kind of missed this window here, or I missed, I think, this incredible run that this has had. Do I think it's on the tail end? I'm no fortune teller. I'm just a guy on the internet that just likes to talk about finance. So who knows? But I think for me personally, I think no, it's not right for me at this period of time. But I tell you, if there's any kind of correction, I'm most likely probably going to jump into this just because I can see that it has room to grow. It's showing that the structure of the fund managers here at Harvest are doing something brilliant with this. So actually, you know what would be a good idea right now is to actually try to figure out how this fund is able to do this. How is it able to achieve 34%? So if we're going to do basic math, this is what we got to do. We're going to start with that 28%, okay? Because we are doing a comparison. So stick with me on this. We're going to go 28 divided by 3. Why are we doing it divided by 3? We'll times that by 2. This would be the coverage that HTAE is participating without any, let me say that again. This 18% is the amount that HTAE participates without any cover call coverage. It's just the 66% that just gets to do whatever the market is doing, whatever the companies it's tracking, okay? Okay, but we got to add another component. We got to add the leverage component. So if we take 28 divided by 4, right, into each of those quarters, so we get 25%. So 25% of that 28 would be 7. So let's add 7. Okay, so we get 25.6. But now we got to add the distributions from January, February, March, and April, and each of them roughly equal out to be $1. So we'll plus 4. We're also going to add one more. Why? Even though we haven't seen a distribution yet for May, we're adding one more because of, again, the leverage component is part of that as well. So we add 1 because it is, yes, 25% of 4. So we get 30.6. Now the rest of this, basically the last little bit, the 4%, probably is simply just made up by the stock selection. It's 20 companies versus 100 companies, and these are 20 companies that have just done really well. And Harvest, I must applaud Harvest for it. I mean, this is probably a video I'll probably maybe do a part 2 and try to do kind of a deeper dive into. But that being said, hopefully you all enjoy this sort of impromptu video. Again, if you like what you saw, subscribe, click all the buttons of the like and notifying variety, and I'll see you all in the next video.